The first variance that I want to talk about is the sales variance. Now, what exactly is the sales variance? Sales variance basically tries to tabulate for you whether the actual sale achieved was more or less as compared to the budgeted number. Okay, so to understand sales variance, before we get into any formula, let's see if we can make it easy in simple, understandable terms. Okay, I budget. In my budget, I had written or I had projected a sale of 5,000 units at 100 per unit. I actually ended up selling 5,000 units, but at a price of 110 per unit. So what is my actual sale? My actual sale is 5,000 units into 110 per unit. Okay, 55, 1, 2, 3, 5,50,000. And what is my budgeted sale? My budgeted sale is 5,000 units into 100 per unit. How much is that? 5 lakh. Actual sale, 5,50,000. Budgeted sale, 5 lakh. So my actual sale is greater than my budgeted sale. Is there a difference? Slash variance? Yes, there is a difference. There is a variance. Okay, of how much? The answer to this question is yes. Of how much? Of 50,000. Did I make a sale of value greater than 5 lakh? Greater than budgeted? Yes, of course. I made a sale of a value greater than what I had budgeted. Now, is it because I sold more units, or is it because my selling price was more? See, I got more sale than what I had budgeted, more revenue than what I had budgeted. But it is not because I sold more units. It is because I sold the same units at a higher price than what I had budgeted. So this difference is on account of charging a higher selling price. Okay. So the variance is called sales price variance. What is the variance called? The variance is called sales price variance. What are the two items between which you are making that comparison? You are making that comparison between the actual price, that is 110, and the budgeted or the standard price, which is 100. So if I were to define my sales price variance, how would it be? Sales price variance is actual quantity sold into actual price minus standard price. And if the actual price is more than the standard price, that means you did a better performance than what was expected out of you. Hence, that variance becomes a favorable variance. Okay. Now, let's not remember one thing in standard costing variance analysis. Do not associate favorable and adverse variances with plus and minus sign. Do not do that. Make sure that you understand it logically. The price at which you sold actually was higher than the standard selling price. And for that particular reason, your performance is better. Hence, the variance is favorable in nature. Okay. So, what kind of a variance is this? This is a variance on account of selling price. So, I call it sales price variance. Okay, actual quantity into actual price minus standard price. Okay, so this was one type of variance. Now remember one thing, okay, I'll keep on repeating this again and again. On the left hand side, okay, on the left hand side, I'm going to write down all the spending or revenue or P&L item related variances. Okay, here sales price variance, inside the bracket up observe karo. Actual price minus standard price. One thumb rule that you will keep in mind in order to remember the formulas throughout standard costing, inside the bracket, you will always have an alphabetical order. When you read A, B, C, D, E, F, G, A comes before S, right? So in the bracket also, A comes before S. और किस चीज का variance है? Price का variance है. So actual price minus standard price. This is the sales price variance. Now let's have another situation. In my budget, I had projected a sale of 5,000 units at 100 per unit, but I actually ended up selling 5,600 units at a price of 100 per unit. I sold more units than planned. Okay, so what is the actual sale? Actual sale is 5,600 units into 100 per unit. How much is this? 5,60,000. Oh, excuse me, I'm so sorry. And what is my budgeted sale? My budgeted sale is 5,000 units into 100 per unit. Now, my actual sale, is it greater than budgeted sale? Yes. Is there a difference or a variance? Yes. Of how much? Of 60,000. Now, did I make a sale of a value greater than the budgeted value? Yes, I made sale of a value which is greater than the budgeted value. Now, is it because I sold more units or is it because my selling price was more? ये variance क्यों आ रहा है? Why is my sale revenue higher? Not because I sold the units at a higher price, but this difference is on account of selling more units than budgeted. So the variance is called sales volume variance. Okay. Now, the formula for sales volume variance, if you are a CA student, the formula in ICAI material is different. There, the formula is standard. This is for CA students. Okay. The formula is standard selling price into actual quantity minus budgeted quantity. For ACCA students, what is the formula? For ACCA students in your ACCA material, the formula is standard margin into actual quantity minus budgeted quantity. So if you really think about it, this is a profit related variance, not a sales related variance. Okay. Actually, this is more of a profit related variance, less of a sales variance. Okay. But in your ACCA study material throughout, this is how they calculate the sales volume variance, actual quantity minus budgeted quantity into standard margin. So they multiply the quantity difference with the standard margin per unit. Okay. Now, how do you calculate standard margin? So SM stands for standard margin. And how is standard margin calculated? Now, if you are using the marginal costing system, okay, so if you are using marginal costing system, standard margin is equal to standard contribution per unit. You know what is contribution? Selling price minus variable cost. And if you are using absorption costing system, standard margin is equal to standard profit per unit. Okay, So now if I have to summarize my formulas, okay. If I have to summarize my formulas, sales price variance is actual quantity into actual price minus standard price. Inside the bracket, you follow alphabetical order. Volume variance is actual quantity minus budgeted quantity into standard margin. We understood just now how exactly is standard margin expressed. Different for a situation where you are using marginal costing, different for a situation where you are using absorption costing. Okay. And the sales price variance, it can turn favorable if the actual selling price is more than the standard selling price. This will happen when, when the market demand is high, there is scarcity of the product, you don't have close competition, you will be able to charge a higher price for the same product from the customer, and customers will pay also. And adverse variance will come in when the standard selling price is less than the actual price. This will happen probably, when you have a lot of competitors in the market, and in order to win customers, you have to slash the prices. Okay. Unexpected price decrease due to, if the customer demand is lower, you want to entice the customers, you might have to offer them a discount. Sales volume variance is quantity related, but as you saw, you multiply this with the standard margin per unit. Sales volume variance can be favorable if there is an unexpected increase in the quantity demanded, maybe because you have slashed the price, or competitors are withdrawing from the market, or your product has no competitors and people suddenly want to subscribe to some units of your product. They will definitely try to buy more units, and your sales volume variance will turn out to be favorable. Okay, now let's do one question to understand how this works. Okay, sure. What is the item that I'm looking at? I'm interested in calculating my sales related variances. Calculate the sales price and sales volume variance for the period using absorption costing and marginal costing. You know that absorption costing and marginal costing has been given so that you get the correct idea on how to calculate the standard margin. So let's do that as a starting point before we go into variance related discussion. Calculation of standard margin per unit. How do we start this? We start this with selling price per unit. Selling price per unit is 60 less direct material 25 less direct labor minus 8 less variable overhead minus 4. Variable overheads will have to be subtracted because while calculating the contribution per unit, all variable costs will have to be subtracted. You will get your contribution per unit. How will you get contribution per unit? Sales minus variable cost. So if you are using the marginal costing system, then this is your standard margin. Okay. Standard margin if you are using marginal costing system. From this contribution per unit, please subtract fixed cost per unit. Fixed cost per unit is minus 18. Fixed cost per unit is 18, you subtract 18 and you will get profit per unit. Okay. Profit per unit is how much? 23 minus 18. Okay. This is my standard margin if I am using absorption costing system. Sorry. Standard margin if you are using the absorption costing system. Okay. So now you have the two important ingredients that you would require to calculate the sales volume variance. Okay, now how to calculate sales price variance? Sales price variance is actual quantity into actual price minus standard price. Okay, what is actual quantity sold? W Limited had budgeted sales of 6,000 units but actually sold 6,000 into standard selling price 60, actual selling price 61. Actual quantity is How much? 6,000 units into actual price. What is the actual price? 61. Standard selling price is 60. 61 minus 60. So what do you get? You get a value of 6,000, and I would call this a favorable variance. Why favorable? Because the actual selling price is greater than standard selling price. Okay. Actual selling price is greater than your standard selling price. You have done a better job than you expected. Okay. And sales volume variance. How is sales volume variance calculated? This is standard margin into actual quantity. Inside the bracket, you will follow alphabetical order. Actual quantity minus budgeted quantity. How does this work? Now, assuming that I'm using the marginal costing system, standard margin is 23 into actual quantity 6,000, budgeted quantity 6,500. 23 5s are 115, correct? So this is 11,500 adverse. Now, why adverse? You had a budgeted sale of 6,500 units, but you sold only 6,000 units. Okay, you had a budgeted sale of 6,500 units, but you sold only 6,000. You performed worse than expected. Hence, I say that my variance is adverse. Now, this is using marginal costing approach. Okay, same thing. If I do it using the absorption costing approach, 23 was the standard margin here. If you are using absorption costing, standard margin is 5. 5 into this, 5 into this is 2,500 adverse. Why adverse? This is using absorption costing approach. Why adverse? You had budgeted to sell 6,500 units. You ended up selling only 6,000 units. So you performed worse than expected. Hence the variance is adverse. We are not associating favorable and adverse with plus and minus. If you performed better than expected, the variance is favorable. If you performed worse than expected, then the variance is adverse. This was about the sales related variance. After sales related variances, we'll be talking about there are multiple cost related variances now that we have to discuss.